Hello and welcome to BQ Prime. A very good morning to all the viewers. One stock that is in focus is GE Shipping. We've already seen how the Q4 numbers have panned out. Strong growth momentum seen on that front, with sales up almost 62%. Yet the profitability, which improved little over three times, and margins have seen a stark improvement as well. But what's the journey going to look like from here on is what we are going to talk about with Mr. G Shivakumar, ED and CFO at GE Shipping. Welcome to the show, Mr. Shivakumar, and a very good morning.
Thank you, Hiral. Good to be here.
Always a pleasure to have you. Overall, Mr. Shivakumar, let me start off with the way the market and the business is panning out, right? Two clear verticals that we have been focusing on let's divide it between shipping as well as offshore. If you have to look at FY24 as a whole, where are you seeing the growth coming from?
In shipping, we have four different types of ships, which is crude tankers, product tankers, LPG ships, and dry bulk. Tankers had a very good year last year, both crude and product tankers. Rates were very high, in fact, the best year since 2008. So we don't know what can happen to those rates, but we have a very high base to start off with for tankers. LPG typically were on time charter. That market is not exposed to the day-to-day movements in the spot market. But that market, again, is quite strong. So you could get some repricings upwards. But that's only four ships, so less than 10% of our capacity. Dry bulk had a fairly weak year last year. There could be potential upside there, but that depends really on how the China rebound works out, what happens with steel demand in China. Coming to offshore, the business is turning around. We had a few very bad years. So it's coming off a low base. All repricings are happening at higher levels, and this is typically a contract business, 6 months to 3 years contract. Repricings are happening at higher levels. So you should get incremental improvements in the offshore business, again, with a lag, because as and when assets come off their earlier contracts. The main thing is that we have two rigs coming off their earlier contracts in FY25. So that impact will mainly come into the P&L in FY26 when they get repriced, if they get repriced upwards.
Right. So, Mr. Shivakumar, let's look at the offshore division itself, right? Now, what we've already spoken right now, you mentioned about the repricing that will happen. Now, what's the kind of fund generation we are seeing in the form of free cash flow by the end of FY25 on the back of the repricing that will happen?
So, some of this is uncertain because the repricings, we don't know what rate those repricings will happen at. We already are at about 40 million net debt in that business. Okay, so we have about $140 million of bank debt and about $100 million of cash. Based on the contracts we have currently, we would expect that goes down to zero within the next 12 months or so, maybe 12 to 15 months. And after that, it's free cash flow. There's, again, positive cash flows. We had a significant period of negative flows, but now we expect that we'll be in positive cash flows from the offshore business, since, again, their debt has come down to very low levels and they have all their assets written down, etc.
Right. So, Mr. Shivakumar, the reason I asked this question is because a couple of brokerage reports, analysts are indicating that the repricing would be somewhere in that range of $35,000 to $40,000 per day for each of the vessels in the next year. And the company would be on track to generate somewhere in that range of 3,500 to 4,000 crores in free cash flow. Is that a number that, investors should work with?
Yeah, first of all, the $35,000 a day improvement in rates is factual. That's around the rate improvement we got when we repriced the last rig. Again, to emphasize, we have only 4 rigs. We have 19 supply vessels. The rigs are the big earners. So the last repricing which happened for the rig was about $35,000 a day, higher than the previous pricing. That's one. The number, I think, which you mentioned of 3,500 to 4,000 crores, I think is for the group, which includes the shipping entity. And the lion's share of that will be in the shipping entity because that market is doing so much better. So we don't have a comment on that number and whether it's right or wrong, because fundamentally we don't know. With 80% of the shipping capacity open to the spot market and almost daily repricing, we don't know what that number will be. But the 3,500 is certainly not relating only to the offshore business.
Right.
The offshore business, had an EBITDA at its peak of about 160, $170 million, which is about 1,300, 1,400 crores. We are nowhere near those numbers.
Right. And overall, if you see in terms of the debt, clearly, the company itself is currently under leveraged. Right. So obviously, the question with regards to selling the fleet or selling any ships is not something that anyone is considering. But what investors and analysts are looking at is what's the further purchase plan going to look like? So what's the strategy on that end?
So we are a cycle player. We play market cycles. We lever up when the markets are low so that we can buy ships. And then what happens is that the ships produce strong cash flows when the cycle turns. And then you will land in a position where you have very low leverage. So you'll start at high leverage in the low markets. And then as your ships produce cash flows, your leverage will go down significantly. And that's sort of normal. It's a normal situation. Yes, we are currently negative net debt. So we have, I think, about $200 million more cash than we have debt. That's in the shipping company. We are waiting for opportunities. You're right that we are under leveraged. But that will happen when you're a cycle player. So we're waiting for opportunities to invest. And we will certainly invest when we find the prices are right. We will try to maintain the discipline in purchasing as far as we can, because we are focused on making good returns on the investments, not so much on the size of the fleet or the size of the balance sheet.
Right. So how much are we looking to invest? Maybe not now. The timeline is something which is unknown, but how much is the company looking to invest in terms of purchases if you have to look at FY 24, 25, 2 years?
We don't have a number in mind. Let me just leave you with one number, which is our fleet value currently in shipping again is in excess of $1 billion. That's at market value. Our gross debt is 370 million, less than 370 million. And we have $550 plus million in cash. So it will be, in that sense, it's easy for us to invest $500 million because we have the cash, we have the leverage capability. So it's easy for us to put out that kind of money in Capex. Again, as I said, we are not in a hurry to do it. We would like to do it, but we will wait for the right opportunity.
Right. And if you have to compare the order book to the replacement demand, where does that stand currently?
So the order book, which you're referring to, I assume, is the global order book for new ships.
Right.
The order book is very low in historical terms, especially for tankers. So replacement demand will kick in, and typically on a trend basis, you should have at least 2 to 3% fleet addition in a year, just to meet the old ships, the demand to replace old ships which are being taken out. And 2 to 3% is a very conservative number. Typically, it's 4% because ships have a life of about 20 to 25 years. So it's not enough to meet the replacement demand for tankers. And therefore, that order book is lining up very positively for shipping. We'll wait, and again, because other kinds of ships have taken up the yard space. So let's see how that lines up. Again, we need demand to pick up. If the risk factor is if the economy or the global economy doesn't do well, then the demand for commodities itself falls, which means that you have negative demand growth. And then it really, then having a low order book doesn't help you, because you need demand to be reasonably strong, or at least to have positive growth in demand.
So, Mr. Shivakumar, one question I have on this is there a risk or I wouldn't say a risk, but a concern when we are not, when the company is not able to replace the ships at the same rate as they are being retired? Is that something which you factor in?
It's certainly a concern. And yes, we would not like to shrink too much in capacity. But as a cycle player, again, you have to be willing to go down and up in capacity. And that's what we are reconciled to. We've seen this in the super cycle, in the boom of 2004 to 8, where there was pressure to keep buying because the market was doing so well. And there was a worry that we were losing capacity. But those decisions did not turn out well, because if you buy them at too high a price, it's really difficult to make money on those ships. And that's what affected us in the first 5 years after we had the global financial crisis. We had very high priced assets which delivered very poor profitability.
Right. And overall, in terms of the company's strategy, the exposure with regards to spot market is absolutely high, right? What is the overall roadmap on that front? Because clearly, yes, we've spoken earlier as well that the long periods, with a consistent spot strategy will always produce better earnings. So, is that something which the company is going to continue doing?
That's right. So we will tend to be spot market players more than time charter players. Our balance sheet enables us to take that risk. Our operating capabilities also enable us to take, to participate in the spot market more than a lot of our competitors. And therefore, we will do that. We may opportunistically, if we find rates to be very tempting, we may take time charters. But again, we're not saying no time charters, we will predominantly be a spot market player. And currently we're at 80% plus in the spot market. It could change, if we find lots of great opportunities, it could go to 70%, but not much below that really.
Right. So just to understand, what's the kind of volatility does it actually cause, having more than 80% in the spot market? Because clearly the quarterly numbers, I was reading your presentation, which clearly said that it impacts the quarterly numbers. So how does the strategy work to make up for the year then?
So you may have poor years. In the long term, you will do better. And it's a little bit like the equity markets. You could have a year where you have negative returns also, but in the long term, you will do better. And you won't be able to smooth it out quarter to quarter because you can't control the pricing on your ships. So we've had terrible years also. In 2018-19, we had a terrible year because the markets were very weak. But we continued with the same strategy through to 22-23, and a good market produced us more profits that could make up for the weak markets, for the lack of profit in the weak markets. So over a long period of time, so over a 5-10 year period, you will find this giving us better return, this strategy giving us better return.
Right. And if you see from a historical perspective as well, between crude tankers, product tankers, as well as bulkers, how is that demand supply trend panning out? If you have to take into consideration the order book, if you have to take into consideration the yard capacity, and all of this put together, because clearly we are almost at a pretty low level as compared to previous years.
Yeah, on the demand side, there are two areas of concern. One is on dry bulk demand, and dry bulk is mainly a China play because Chinese import demand for iron ore and coal have provided more than a majority of incremental dry bulk demand over the last 20 years or so. And Chinese steel production seems to be slowing down. There's not much growth. The first 4 months were okay, but it's been slowing down in May, year on year. So that's a little bit of a concern. Again, it's driven by what's happening with the Chinese property market. On the oil market side, gasoline demand, aviation fuel demand have been pretty strong in terms of growth. However, diesel demand has been poor. Again, diesel is more of an industrial demand commodity. It's used for trucking and things like that, which are more industrial in nature. So there seems to be some stress there as well on the oil demand front. So that's where we are seeing demand. It's not a very clear picture yet, but we're not yet getting great confidence saying that the economy is back in a big way.
Right. So very lastly, Mr. Shivakumar, what are you building in terms of FY24 internally? What are your estimates looking like?
So there's a quote from a famous investor, which is, "You can't predict, you can prepare." So we
Absolutely.
don't try to predict because we don't know. And quite frankly, we don't know because the market changes so much on a day-to-day basis. And sure, 80% of your fleet is in the spot market. There's no use trying to
Hmm.
forecast. So we have our ships on the spot market. We believe the market will be pretty positive. But again, who knows what happens in China, whether there is a sudden real estate boom, if there's a stimulus and suddenly dry bulk demand picks up. We just don't know. And therefore, we just keep our ships operating and typically operating in the spot market so that we are there to take advantage of these opportunities.
Absolutely. I think lots to look out for as well during the year. Thank you, Mr. Shivakumar, so much for speaking to
Thank you,
us and
Gary.
giving us that understanding of what it would mean as well from a market perspective. Thank you. Stay safe and speak to you soon again.